Hello and welcome to an educational video brought to you by Bayntree Wealth Advisors. My name is Christina Perez and I'm a certified financial planning professional and financial advisor here at Bayntree. Today I'm going to be talking to you a little bit about traditional and Roth IRAs. Let's get started. First, keep in mind this video was created for educational purposes only, and this information is general. Therefore, it should not be seen as specific investment advice, and we would encourage you to consult your financial advisor to discuss how you can use these vehicles for your specific situation. So, an IRA is an individual retirement account, and they were created for employees whose employers did not offer a retirement plan, such as a 401k. So, the key to take away here is IRAs are a way for you to save separately from your 401k or other employer sponsored plans. Uh, the most common types of IRAs are going to be traditional and Roth IRAs. However, there are a few additional ones. But since the most common ones are these two, that's what we're going to focus on today. So here we just have some of the main differences between the two different types of IRAs. The traditional IRA allows you to make pre-tax contributions, whereas the Roth IRA, you would make after-tax contributions. Both of your contributions would grow tax deferred. The difference with the Roth IRA is the earnings have the potential to come out tax free, on top of the contributions always coming out tax free. Since you're actually putting in your after tax dollars, meaning the paychecks that you receive at the bank, which have already been taxed, the way that it becomes a pre-tax contribution is by getting a deduction for the traditional IRA contributions. Whereas with a Roth IRA, you wouldn't get a deduction because the whole point is to put in after tax money. So a little bit more on contribution limits. Both of them have the same contribution limits, being $6,500 if you're under 50. If you're over the age of 50, there's a catch up of $1,000. Keep in mind this limit is for all IRAs. Therefore, if you contributed $3,000 into a traditional this year, then you would only be able to contribute an additional max of $3,500 into the Roth. Furthermore, the Roth IRA is going to be subject to income limits that if you are over the income limits, which also has to do with how you file your taxes, then you may not be able to contribute directly to a Roth IRA. That is when potentially making backdoor Roth contributions may be a strategy that you can look into with your advisor. On the other side, with traditional contributions, you are able to contribute regardless of your income. However, whether you're able to get a deduction will also depend on if you're participating in a 401k or if you're married filing jointly and your spouse is participating in a 401k, then you will be subject to what are known as deductibility income limits. So these are all special rules that you'll want to definitely look over to make sure that you are eligible to contribute and what amount. Now, another big difference is withdrawals from each of these IRAs. With a traditional IRA, since you got a deduction or a tax benefit when you contributed, any amount that comes out after 59 and a half would simply be treated as ordinary income and would be taxed at that point. If you took out any money from the traditional IRA before 59 and a half, there would be a 10% early distribution penalty unless you met certain exceptions. For a Roth IRA, it's a little bit different because even if you're under 59 and a half, they would allow you to take out your contributions tax and penalty free. And once you're over 59 and a half, then and have had the IRA for more than 5 years, then all of the withdrawals would be tax free. That is correct, tax free. Another big difference is a traditional IRA. Once you turn the required minimum distribution age, which currently is age 73 and will go up to 75 in the year 2033, you are going to be required to take out a certain amount each year. Whereas with a Roth IRA, that account will not be subject to required minimum distributions. So, what are the key takeaways? The traditional IRA is going to give you tax benefits now, but then the withdrawals are going to be taxable later. Whereas the Roth IRA, you're paying the taxes up front now. Both of these contributions are going to grow tax deferred, but with the Roth IRA, as long as you meet the 5-year holding period and are over 59 and a half, all of the withdrawals would be tax free. If you want to see more, we definitely would encourage you to watch our video of our owner, Andrew, having a discussion with tax expert Ed Slott. Or lastly, if you would like to contact us to have a further discussion about how these vehicles can be used in your financial plan and portfolio, here's our contact information, and definitely don't hesitate to give us a call.